Hey guys, what's up? This is Ron Parks here and welcome back to my channel. I want to talk today about mortgage and FICO credit scores. It is much harder to get a mortgage now than it was just 3 months ago. Mortgage credit availability in May fell to the lowest level in 5 years, according to a survey by the Mortgage Bankers Association. Lenders cite a large drop in liquidity as investors in jumbo mortgage-backed bonds pull back. Mortgage-backed securities, also known as mortgage-backed bonds, are collateralized by mortgages, which are often residential mortgages. They're created by pooling together mortgages purchased from the original lender. Investors receive monthly interest and principal payments from the underlying bonds. Jumbo mortgage-backed securities include a pool of only jumbo loans. These are mortgages of $510,000 in most parts of the country, and $765,000 for high-cost areas like Washington, D.C., and some parts of California, where single-family home prices tend to be above average. If mortgage-backed bonds are not being pooled together as fast as it has been in the past, then there is a liquidity issue, as banks usually lend money with the understanding that they can pool these loans and sell them off to Freddie Mac and Fannie Mae to get them off of their balance sheet, so they can start the process all over again. So it is important to get all of your ducks in a row before you apply. You might be asking yourself, do lenders use FICO scores to approve or deny a home loan? Well, first we need a little background. Consumer credit files are now maintained by 3 national firms, Experian, Equifax, and TransUnion. These organizations collect all the reported credit information that creditors provide on consumers. Every credit card, car, or installment loan you have will be reported to these agencies usually at month's end or more. They include information on whether you are paying on time, do you have any late payments, are any accounts delinquent, or have you had a bankruptcy filing recently? While you might think all 3 agencies would have identical information, the reports often report different information for the same person, and some differences are substantial. When you apply for a credit card or an auto loan, the lender will buy one of 3 credit reports directly from one of the 3 credit reporting agencies, Experian, Equifax, or TransUnion. They will use that information and the score they bought at the same time to make their approve or deny decision and set the terms of your new account. That process occurs hundreds of thousands of times every single day. But when you apply for a mortgage loan, the game changes. Mortgage lenders don't typically buy just one of your credit reports, they buy all 3 of them. And if you're applying jointly with a spouse or someone else, the lender will buy all 3 of their credit reports also. So we're looking at 6 credit reports and 6 FICO scores, of which the lender or broker will take possession of. So lenders use residential mortgage credit reports to learn more than just your credit record. Banks and mortgage lenders also want to verify your employment and residential history to be sure you meet the guidelines set by the major buyers of these mortgage loans, such as Fannie Mae and Freddie Mac. These reports also minimize the probability that an outstanding loan or problem account will be missed by one of the 3 credit reporting agencies. This is also known as tri-merge credit report. 3 reports merged together. Now that's a lot of credit reports and a ton of redundant information. Think about the joint credit card you have with your spouse. That likely shows up on all 6 of your collective credit reports. Does the mortgage lender really need to see the same account 6 times? Of course they don't. Because of the large amount of credit report data required by mortgage lenders, they need a third party to filter through all of the information. This service accesses all of the credit reports required by mortgage lenders from the big 3 credit bureaus, and then consolidates them into one easy-to-read credit report. This report is called an RMCR, or Residential Mortgage Credit Report, and the companies that provide them are referred to as mortgage reporting companies. These companies act as brokers or resellers of the data maintained by Experian, Equifax, and TransUnion. The mortgage lender will subscribe to their services and commonly request a credit report on a mortgage applicant or applicants. The mortgage reporting company will then go to the big 3 credit bureaus on behalf of the mortgage lender and buy the applicant's credit reports and FICO scores. But before they deliver this large amount of information back to the mortgage lender, they'll combine the information into one report. The credit score information will be displayed in one section, all the negative data will be displayed in another section, And things like inquiries and personal identification information will be displayed in their own sections. This merged credit report is considerably easier to read than reading 6 separate credit reports. The report will note 3 credit scores, one for each reporting bureau. And depending on the accuracy and thoroughness of each bureau's information, the 3 scores can be close or significantly far apart. This is because each bureau uses a different algorithm and formula for computing credit scores, and the credit bureaus work with different source material. Unlike standard credit reports, residential mortgage credit reports include manual information updates at least every 90 days. So most mortgage lenders consider the RMCR valid for 90 days. And since most mortgage loans are closed in 4 to 6 weeks, typically within 60 days from the application, one report is usually sufficient. However, if your loan closing is delayed or you've corrected some negative credit information, lenders may pull another residential mortgage credit report to have up-to-date data in your application file. You can now get your standard credit report, your FICO score from one of the 3 agencies for free, regardless of your employment or financial situation. Federal law mandates that each agency provides you with a free copy of your credit report at your request once every year. And you can see the link below for the website where you can get the report for free. If you've applied for a mortgage-related loan, you probably have your RMCR in your closing paperwork. As mortgage brokers and lenders will often give you a copy, it's a very valuable aggregate of information because it's a comprehensive study of all of your credit reports and includes your actual FICO scores, along with the reasons why each of them wasn't higher. So before you apply for a mortgage loan, I recommend you follow these few steps to maximize the chance of a successful transaction. Get a copy of your credit report and review all the sections and make notes about items that look wrong or where you don't recall the transaction. I would also check your credit card statements for gray charges. These are charges that appear on your credit card statement either without your knowledge or due to businesses using dishonest tactics. The most notorious of these, getting a free trial for a service and then auto billing starts once the trial is over. And some examples of some other gray charges include subscriptions you sign up for while completing another purchase, getting a service for free but not knowing it turned into a paid subscription, and cost creep, which is when the initial cost for a product or service increases after a certain amount of time without your knowledge. And also money-back guarantees that you neglect. That means you're charged until you return the item or cancel the service. So go online to each credit bureau with your list and file a dispute. The credit agency will look into it, and if the data is incorrect, remove it and correct it. I would also find out when your issuer reports payment history. Call your credit card issuer and ask when your balance gets reported to the credit bureaus. That day is often the closing date or the last day of the billing cycle on your account. And remember, that's different than the due date on your statement. There's something called the credit utilization ratio, which makes up about 30% of your FICO score. This is the amount of credit you've used compared to the amount of credit you have available. You have a ratio for your overall credit card use as well as for each credit card. It's best to have a ratio overall and on individual cards of less than 30%. But here's an insider tip. To boost your score even quicker, keep your credit utilization ratio under 10%. Here's an example of how the utilization ratio is calculated. Let's say you have 2 credit cards. Card A has a $6,000 credit limit and $2,500 balance, and Card B has a $10,000 limit and a $1,000 balance on it. So your utilization ratio on Card A is 42%, $2,500 outstanding divided by $6,000 credit limit. And this is way too high. And Card B has a 10% utilization, $1,000 outstanding divided by $10,000 credit line, which is awesome. This is your overall credit utilization ratio combined of 22%, which is pretty good. But here's the problem. Even if you pay your balance off every month, and you should, if your payment is received after the reporting date, your reported balance could be high, and that negatively impacts your score because your ratio appears inflated. So pay your bill just before the closing date. That way your reported balance will be low or even zero. The FICO method will then use a lower balance to calculate your score, and this will lower your utilization ratio and boost your score. In summary, remember that these reports are only as good as the data the agencies receive. If you follow some of these tips before you apply for your mortgage, it is way safer to make sure your information in the reports are accurate, timely, and verifiable, and you will have the best chance to get approved. So look out for my next video this week. I'll give you some fast tips on how to improve your credit score in 5 easy steps. Thanks for watching, and if you really enjoyed this video, please subscribe and smash the like button, and I'll see you next time.